Welcome back to the Global Ledger. I'm Justin. In the last episode, we looked at how the central bank steps in when markets can't function, acting as a dealer of last resort to stabilize liquidity during stress. Today, we turn to the institutions that normally provide that liquidity every single day, and that is the primary dealers. These firms are pretty much the front line market makers of the U.S. Treasury market and the bridge, you could say, between the Fed and the financial system, and really the core distributors of dollar liquidity worldwide. Let's break it down. So, what are primary dealers? Primary dealers are a select group of financial institutions that are authorized to transact directly with the Federal Reserve Bank of New York. Their responsibilities include bidding at Treasury auctions, making two-sided markets in U.S. government securities, providing liquidity to investors really around the world, and participating in the Fed's monetary operations. Really important key one there. So think of them as the wholesale dealers of the global dollar system. When treasuries move, when liquidity shifts, when funding tightens, these are the institutions absorbing the flows. So why they matter? Almost every major financial participant relies on primary dealers. This is banks, pension funds, money market funds, corporations, hedge funds, foreign central banks. We'll get into foreign side a little later. Sovereign wealth funds, another one. So whenever someone buys, sells, hedges, or finances treasuries, a primary dealer is almost always on the other side. So they are the plumbing of the treasury and repo market structure. Let's take a look at how they fit into the Fed's operating framework. So the Federal Reserve conducts its monetary operations through these firms. And referring back to a chart that we talked about, or a paper that the Fed published in July of 2025 this year, they mention they talk about the trading desk and how it executes open market operations with a set of approved counterparties, and primary dealers are central to this process. So this means when the Fed wants to add reserves, it buys from the primary dealers. When it wants to tighten, it sells to primary dealers. When it stabilizes funding, it executes repo with primary dealers. So the central bank sets conditions. Primary dealers transmit those conditions into open market pricing. So they are the operational link between policy and the marketplace. So how do primary dealers make markets? And how do they earn money? So number one, bid-ask spreads, really common. We see these in everyday prices. So quoting buy and sell prices continuously in massive volume. Number two, I'd say repo financing, financing their treasury inventory overnight with repurchase agreements. Big one too. Number three, inventory absorption. So holding large positions when investors sell. This provides stability and order too. So number four, I'd say distributing new treasury supply. So when the U.S. Treasury issues new debt, primary dealers are there to buy and distribute it. So they do not simply participate in the system. They really are the system's market-making infrastructure. So extremely important. What about when they pull back? And how or why you could say they become bottlenecks during stress. So when primary dealers pull back, say because of volatility or funding pressure or constraints on leverage or even regulatory capital limitations, you could say, liquidity can evaporate really across the entire market. So this type of dynamic, I should say, contributed to 08, 2019, and 2020. So every time, what broke wasn't the system as a whole, it was dealer balance sheet capacity. So if primary dealers cannot or will not intermediate flows, the entire dollar system can freeze. So what about from a global dollar perspective? Because the U.S. Treasury market really is the foundation of global collateral, global reserves, global funding, and really overall global risk management. So foreign governments, multinational banks, and global funds all rely on liquidity of treasuries. So primary dealers are the institutions ensuring this liquidity exists. So they make the dollar usable beyond U.S. borders. So key global link for primary dealers in the global system. So let's talk about the connection to valuation and market pricing. We've talked about the connection to the global stage. So as we look back on our talks here, every valuation model we talk about relies on a stable yield curve and predictable funding costs, a functioning collateral market, and really an efficient pricing of risk. So primary dealers stabilize all of these. So when they expand balance sheet capacity, markets deepen, spreads start to tighten, see volatility fall, and you'll see valuations start to strengthen. So when they retreat, again, liquidity dries up, widens, wider spreads, and valuations reset, kind of thing. So they indirectly anchor, I say the discount rate that underlies modern asset pricing. So once again, thank you for listening to episode 22 of the Global Ledger. Next episode, we're going to stay inside the dealer ecosystem and take a deeper look at repo financing, the mechanism primary dealers use to fund their inventory and support the global dollar liquidity. Thanks for being here.